It has been a historic week here in the U.S. With the new administration in place at the White House and here on Wall Street, we did get that record high for the Dow Jones Industrial Average. So joining me to weigh in on this week's action is Keith Bliss of Cuttone Co. Keith, good morning and great to have you on the show.
Good morning to you, Remy.
Well, it has indeed been a historic week across the U.S. and here on Wall Street. Now, we finally got that break above the psychological 20,000 level for the Dow. So what's next?
Politics and finance, isn't that what we always want to talk about? It seems that way, certainly in the last few years. So with the Dow and all the major indexes, I think we continue to move higher. We still don't see the markets overbought, short-term overbought at this juncture. We probably have another 200 points to go inside of the Dow before we get to that level, probably 40 to 50 inside of the S&P. That doesn't mean that the markets are richly priced to traditional metrics. It just means in a very short-term nature they're not overbought yet, and I think the market will keep moving higher. One of the patterns that I always look at is the dollar-euro trade, and right now the dollar in its sell-off last week and the early part of this week is oversold and the euro is overbought. That is generally a positive pattern for U.S. equities, so that underpins my thesis of why I think we'll get more gains out of it. The one index that we do need to look to confirm all this movement is the Russell 2000. That has not gotten back to its own all-time high, its own all-time closing high. It's very close, but that's 1388. That's the mark that people should look for. If we get above that and we stay above that, then I think it's full speed ahead. These markets will keep ripping higher.
Okay. Well, now that we've broken above that level, we have more important things to focus on, including the Fed, which is coming up next week. Now, if you look at Fed fund futures, we aren't pricing in a hike at this meeting, but everybody will be paying attention to comments coming out from the Fed. So what do you expect from the Fed, and what do you think they're thinking right now?
Well, I think the Fed is certainly watching what's going on inside of the Oval Office at this point in time, even though Donald Trump and the administration has not moved on the bigger economic issues, tax reform, regulatory rollback and reform, and infrastructure spending. What the market is sensing, I think what the Fed is looking at, is that the Trump administration is moving swiftly, moving aggressively, and moving decisively on all the things that they talked about in the campaign thus far. So that's one reason why the market was able to break through that 20,000 barrier and will probably continue higher, is that now the thinking is, instead of all those big economic plans getting done maybe in 2018 or even 2019, they'll get done this year. So people are trying to get ahead of that trade. The Fed is thinking the same thing at this point in time.
And Keith, there's so many moving parts when it comes to how we're factoring in what will happen in the long term and what the bigger picture really is. Now, I know that you take a look at indicators that most financial headlines don't necessarily mention.
Right.
This week we had many executive orders that were signed in, and that has a lot of implications for the environment and immigration. And if you walk around New York City, there were protests. So without going into too much of that, where do you think the best plays are in terms of the market right now?
Given all that I see and given all that I think will occur, you're right, regardless of some of the social unrest that's been in the immediate aftermath of the inauguration and how that may impact the economy, both positively or negatively. Financials still remain a favorite of mine for a couple of reasons. The marketplace is set up to reward financial companies, increasing rates, a steepening yield curve, friendlier regulation perhaps, not a complete abolition of the Dodd-Frank bill, but certainly a softening of some of the more pernicious components of it. So a friendlier regulatory environment, a growing economy both here and abroad, which will help banks and other lenders. And financials have been beaten up for years. They've, money just has not found them, and money's starting to find them. So financials are good. Industrials are also good. Industrials will benefit tremendously from President Trump's agenda, even just pieces of it, not a total implementation. So I would like industrial companies, especially the industrials that play in the defense industry, despite the way he's beaten up Lockheed Martin and Boeing over the last couple of months. They will benefit as we re-engineer and rebuild the military here in the U.S. and with our allies, quite frankly. So those are really the two best places to put money right now. Stay away from things like utilities, REITs, interest rate sensitive types of sectors and industries, and also acting as bond proxies, which brings to mind, would not touch bonds or bond ETFs right now.
Okay. Well, Keith, thank you so much for joining me today, and as always, thank you for all your insight.
My pleasure.